Believe it or not, there are moments in the property cycle where the smartest move isn't buying and it isn't selling. It's getting ready for what is to come. Right now, being mid-November in 2025 definitely feels like one of those moments. A lot of homeowners are sitting on more equity than they've ever had in their lives. But what most people don't realize is that equity is useless if you can't access it. And if you wait until you need it, you've probably waited that little bit too long. So in this video, I'm going to show you exactly how equity works, how to access it before you need it, and why you should be preparing yourself ahead of everyone else next year while they're all getting ready for their Christmas lunch. But before we keep going, if you've been enjoying my content, I just need to ask you one favor. Hit the like button. It really helps grow the videos and also helps really grow the channel so I can keep making this content for you. Okay, let's start simple. Equity is just the difference between what your home is worth and what you still owe on the loan. If your home is worth $2 million and your loan is $1 million, basic maths will tell you you have $1 million in equity. But that isn't all available to you because the bank doesn't let you actually borrow every single dollar of your equity. Most lenders are going to cap you at 80% of the property's value. This is what we call usable equity. So in this example, 80% of $2 million is $1.6 million. You already owe $1 million to the bank. Usable equity is $600,000. That's the number that actually matters. That's the number that gives you your options. Now, just because you have equity doesn't mean the bank will actually give it to you. You might have $500,000, $800,000, even $1 million in usable equity, but if your income doesn't stack up and support the repayments on the larger loan, then guess what? The bank's just going to say no. So whenever we get a loan, the bank cares about two things the most: security, which we have in our equity, and then the income and serviceability. To access the equity, you need a balance between the both of them. If you don't have one, but you have the other, you're not going to be able to get the equity out. So when we talk about releasing equity, what we're really talking about is the equity available plus the income you have to support it. If both boxes aren't ticked, you simply can't access it. It really is that simple. But before we keep going on, if this is sounding like something you want to do with your property, book a meeting with me using the link in the description, and you can work with myself and the team to secure your finance and prepare yourself for 2026. Now, most investors don't prepare early, and I see it all the time. They wait until they've found a good deal on an investment property and then they try to scramble to get a refinance together on their owner-occupied property. By the time you apply, the bank orders a valuation and the lender assesses your application, the opportunity has disappeared into thin air. You simply can't do anything because your cash is stuck in your house and you didn't prepare early enough. I see it every year. People miss out on opportunities because they try to access their equity at the last second and they can't get everything together in time. Releasing equity realistically takes 2 to 8 weeks. Sometimes it can take even longer. We've got to go through the hoops. There's income verification, valuations, lender turnaround times, and then there's settlement delays because your outgoing bank definitely doesn't want to let go of your mortgage. It's not a fast process by any means. If property prices are starting to dip, if a rare opportunity pops up, if a seller needs an urgent deal, you need that money ready that day, not in 6 weeks. But the number one objection I get to this is though, what if I release my $600,000 in equity and I'm paying interest before I'm even ready to use it? The simple answer is you won't if you select interest-only repayments. Because when you refinance and release equity, you can just park that money straight into an offset account against that new loan split. If the full amount sits in offset, the interest is effectively zero. So what you get in this situation is access to your equity, no interest cost until you actually use it, and instant readiness when the opportunity appears. This is what it's all about. And this is how experienced investors operate. They release equity early, store it safely in an offset account, and then they just sit there and play the waiting game. So why is late in the year a good time to do this? So if we're talking 2025 specifically, the property market is very hot at the moment, especially if we're talking in Melbourne under the $950,000 mark for the first home guarantee. These properties are moving extremely quickly. This means property prices have increased and your usable equity is probably as high as it's ever been. Next year, if demand starts to slow down a little bit, your usable equity may shrink along with it. 2026 is being tipped as the year of opportunity, particularly here in Melbourne. Investor lending is coming in at an all-time high and the first home buyer market is moving faster than we've ever seen before. The general sentiment is that 2026 will present opportunity. Don't you want to be ready for that? And of course, restructuring now is fast action for next year. You want to be able to act quickly when the good deals start to appear at the end of January when the real estate agents return from their holidays. And this is the whole point. You want to be able to act quickly when the deals come back online when the real estate agents return from their month-long holiday in the Gold Coast. You have to get ready this year. You absolutely cannot restructure in the middle of an opportunity. You have to restructure before it happens. But when we talk about preparation, releasing equity isn't the whole story. Being prepared also means that you need to build a cash buffer. enough to cover rate rises, vacancies, and emergencies for the property you're going to purchase. You need to consider interest only for flexibility. This improves your cash flow, keeps holding costs predictable, and gives you breathing room while you wait for the opportunity to appear. Another thing to do is keep your equity separate. Store it in its own offset split. This avoids any tax issues later on and it keeps things clean for investing. Your accountant will thank you later. And then while you go ahead and restructure, you need to set up a pre-approval at the same time. If you know your budget and you've got the funds ready, you can negotiate harder and faster when they come online. It sounds simple, but being prepared will give you the best chance to secure a good deal in 2026. Now, as an investor, there's one thing to keep in mind. First home buyers are the most active I have ever seen them. Government schemes, low deposit pathways, and stamp duty concessions are keeping demand strong even when investors have been sitting out of the market. And all the changes with the first home guarantee, this is just producing even more demand. The lower to mid price ranges in each state have stayed surprisingly resilient and they are starting to rise. So just remember, if you see an opportunity next year, you are not going to be the only one looking. It's going to be other investors and it's going to be first home buyers who are buying with emotional money. You absolutely cannot time the market, but you can time your readiness for the market. Banks move slowly, but sellers and competing buyers won't. If you want to act fast next year, you need to prepare yourself.